Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. Today, we have a terrific lineup ready to discuss the most relevant topics as we near year end. The topic of today's live stream is wealth transfer planning turned upside down. To kick things off, we have Melissa Labont, a tax principal out of our Arlington, Virginia office here to provide insight on estate and gift tax legislation. We'll then invite Tammy Neal, a tax principal out of our Orlando, Florida office, to further discuss individual estate and trust tax rate changes. Welcome both.
Thank you, Matthew.
Thank you.
Before we dive in today, we have some housekeeping to cover. We have the ability for a live Q&A during today's session. In order to participate, you must be registered and logged in using the link below me. The questions will appear for you in the audience to see and like and move up in priority so that we can address them. We have moderators standing by, ready to engage and interact with you. In addition to webinars, be on the lookout for articles and other white papers providing additional guidance. And as always, call your CLA relationship. We want to hear from you. Before we begin today, make sure to go ahead and smash that YouTube like button so that these resources can be shared to other subscribers. Melissa, let's kick things off. Can you tell us a little bit about some of the changes that are being proposed in regards to gift and estate planning?
Yes, thank you, Matthew. House Ways and Means Committee had some proposals, and now it's part of this reconciliation package that's going to be brought up in the House. And there are major changes with regards to estate and gift tax planning. First change, we have a reduction in the estate and gift tax exemption. This is the amount that you can transfer out of your name during lifetime or at death without having to pay a transfer tax. So currently we have a $11.7 million per person exemption. So roughly $23 million for a couple. Under the proposal, that amount would drop in about half. So we're looking at roughly $6 million for next year. Because of this, we're going to see a lot of individuals trying to take advantage of that higher exemption amount before December 31st. Another major change, Matthew, deals with the proposed rules on grantor trust, certain grantor trust. These intentionally defective grantor trusts is what we call them. They are irrevocable, so you can't change your mind, right? And what happens is individuals put assets in the trust, they retitle them, and they get them out of their estate for estate tax purposes. However, this is the good part, you're still treated as the owner for income tax purposes. So whatever income is earned by this trust, that income is still ultimately reported on your personal tax return, and you pay the taxes on it, which surprisingly is actually a good thing. Right? Normally footing someone else's tax bill, not a good thing. But in this situation, you're basically footing the bill for whoever the beneficiaries are of the trust. And it's not treated as a gift. So again, it doesn't reduce that exemption amount. In other words, you kind of get to, have your cake and eat it too. Big change for folks that are in estate planning because it's a very, very popular technique. Another thing that's in the proposal deals with what we call valuation discounts. Whenever you transfer an investment in an entity, not a publicly traded entity, usually a small, closely held entity, whether it's shares of an S Corp or LLC interest, the value is generally not the proportionate share of the total assets in the business, right? Sometimes it's less when you're transferring a minority interest or a non-controlling interest. Right? The appraiser considers how difficult it would be for you to sell that particular interest. And it lowers the value of the business for gift and estate tax purposes, which, surprisingly, it's a good thing. The lower the value, the less of that exemption that you're going to use. Or if you've already used up your exemption, that means less tax that you would owe. So these discounts would be going away for types of transfers that deal with investments and non-business type assets. So if you have a family limited partnership where you pool all of your money together to make investments on behalf of the family, those kinds of discounts and valuing those business interests would go away. What was not included in the House bill, Matthew, but we do get a lot of questions about it, is the repeal of the step-up in basis. Right now, while you're alive, your basis is generally what you paid for something. Yeah, there's some, adjustments and stuff if you're depreciating it. But let's say you bought publicly traded stock for $10 years ago. It's now worth $50. If you were to sell that stock, you would have generally a capital gain of $40. But instead, if you hang on to that stock that you paid $10 for and you pass away, you get hit by a bus or what have you, and let's say it's worth $40, your heirs get to have that stepped up, that higher amount of the basis, fair market value, as their new basis. So if they were to turn around and sell it the very next day, there would be no gain. Even though you paid $10, it was worth $50 when you passed away, they sold it a day later, they had no capital gain. So it's been around for many, many years, and an important aspect, and one of the things we get a lot of questions on.
Thank you, Melissa. One of the questions that came through is, does the step up in basis apply to farmers and ranchers, specifically the person receiving the ranch or the farm?
Well, with the step up in basis, they're going to continue, at least for now, it looks like, they're going to continue the current rules. So that step up in basis, those rules would continue for all taxpayers, including ranchers and farmers.
Thank you, Melissa. That's really helpful information and insights into the proposals. If you do not mind, let's bring Tammy into the discussion. Tammy, I know that there are some proposals to increase tax rates for individuals. Would those proposals also affect trusts and estate rates?
Yes, Matthew, they do. So the 39.6 proposed top marginal rate would also apply to trusts. And for trusts, it kicks in currently about $13,000 of income. They would be at the highest 39.6%.
Thank you, Tammy. Let's shift gears a little bit and talk a little bit about the IRA rules. We're hearing that there might be some changes to the IRA rules, and IRAs are a great vehicle to save and build wealth. What sort of changes might we expect?
Oh, I'm sorry. Was that for me, Matthew?
Yeah, Tammy. If you can answer this one, what kind of IRA rules would you expect, or the changes would you expect to see in these new proposals?
So some of the rules apply towards taxpayers that have what we call mega Roth IRAs, so higher than $10 million. But interestingly, we have the opportunity to manage AGI. So if in a current year their AGI is low enough, which is all of the tax proposals are somewhere in between $400,000 and $500,000. But if you qualify, you wouldn't have to do a distribution. But if you had a year where, let's say, you have $1 million of income and your IRA is over the $10 million, it's about 50% of the excess that would have to be distributed. Some other changes, they're obviously doing things to make businesses offer retirement accounts. But one of the things that they're trying to do away with is the opportunity to do what we call backdoor Roth contributions. So you would there's income limits on being able to contribute to traditional and Roth IRAs. And so one strategy is contributing a non-deductible contribution to a traditional IRA, and then it gets converted to a Roth without any consequences. So they're eliminating that loophole in the proposed legislation.
And sticking to the IRA for a second, are there any specific tax strategies that we can implement now in preparation for any potential changes to the IRA rules?
So when I'm talking to my clients, some are business owners, and one thing that I would be looking at, a lot of clients are asking about converting their traditional IRA to a Roth. So it's a good strategy to consider if they happen to have losses or it's a low income year. So, converting it in tranches to not necessarily get into the 37%, because I'm never a fan of prepaying tax. But because we can't deduct net operating losses from businesses in 21. We can't carry them back. We can only carry them forward. So that would be a great opportunity, tax planning opportunity to consider converting your traditional IRA to a Roth in that year or in this year.
Thank you, Tammy.
Mm-hmm.
Melissa, let's jump over to you for a second here. Are there any conversations, kind of going off of our last conversation there with Tammy, are there any conversations that we should be having with our clients concerning the estate and trust rules or potential changes, any proposals within these, that could affect our clients?
Well, we did mention that $11.7 million could potentially get dropped to $6 million. And even if the proposal doesn't get passed, it's already scheduled to sunset after 2025, Matthew. So a lot of folks are considering, what am I comfortable gifting away now, right? What am I comfortable I can get it rid of out of my estate? Or there are some other trusts, like a spousal lifetime access trust, where I'm probably going to get it out of my estate, but if we absolutely need access to it, my spouse might have access. So a lot of those conversations are going on to use that 11.7 million, because once it drops, the IRS has said that they're not going to go back and try to collect tax, because when you transferred it, it was allowed. That was the rule at the time, that you could transfer it tax-free. So there's no what they call clawback. So folks are going to be continuing to make gifts between now and the end of the year to use that, as much of that exemption as possible. And if you're going to be transferring, let's say, less than 10 million, 11 million. Sometimes it's better, instead of having both spouses transfer 5 or 6 million, it might make more sense to have one spouse transfer it, and he or she can fully utilize their exemption. And when the exemption amount drops, the other spouse still has the ability to make gifts without having to pay tax. So we're having those conversations as well. And then with the change of the intentionally defective grantor trust, those fancy grantor trust we talked about, that is proposed to take effect not at the end of the year, but date of enactment. So whenever President Biden would sign on the dotted line, those rules would take effect. So if you're already working with an estate planning attorney and CPA, you would be doing whatever you can to get those trusts created and to get them funded as soon as possible before anything gets proposed.
And, one thing, if we had a crystal ball, we would have a lot of great answers. But any idea on timing here as to when we can see some of these enacted?
Great question. I would say it's probably unlikely we're going to see something before mid-October, but I have been wrong many times before, and it could easily slide, right? It might be November, December. We really don't know, Matthew, but every day things are changing. Every minute, actually, we're getting updates.
Thank you. Thank you. Sometimes, we get a lot of technical questions in our live stream, and this one came up, and I don't know if you've got all the resources here to answer it, but maybe you could take a try. So, within our wealth planning and advising, we've got hard assets, we've got, cash and other liquid assets. When there's a residence in the estate, is appreciation typically taxed? And would that be something to consider as we, proceed?
So your gross estate would include all of your assets that are in your name. Okay, so let's assume it's not in a trust that was set up to get it out of your estate. The value of your property would absolutely be included in your gross estate for tax purposes.
Okay.
So do you mind if I just jump in with a little nugget there, Matthew?
Please.
So to the extent that you have a surviving spouse and we could transfer, so the surviving spouse then takes possession of the home, we still do have the gain exclusion under Section 121. So for a single person, if they happen to sell the property in the tax year that the decedent passed, you would have the $500,000 gain exclusion, but $250,000 for a single taxpayer. So if you had a surviving spouse that lived in it for several years, it would be included in the state, but it would pass tax-free under the marital exclusion. and then they could sell the residence under Section 121 and have at least 250,000 of deferral. Or sorry, exclusion, not deferral, exclusion.
Yeah, and thank you, Tammy. And as you sort of expressed there, this is very technical. So obviously, every folks who are listening, you want to make sure you're reaching out to us and your tax professional to make sure you're getting the best tailored guidance and advice that suits your circumstances. So, Tammy, Melissa, are there any other thoughts that you want to present while we're on the live stream today?
So if you don't mind, yeah, absolutely. So the 3.8% Medicare surtax that applies right now to passive income is part of the proposal. So that's going to apply even if the assets are in a trust or estate. And then there's a new 3% surcharge. So that's going to apply to taxpayers, to individuals that have over $5 million in a tax year, and to estates and trusts at $100,000. So it's just an additional 3% tax. So if the trust is already in the 39.6% because it's over 13,000, if it's over 100,000, it's going to have the additional 3%.
Thank you. Thank you, Tammy.
Mm-hmm.
Melissa, any other thoughts or updates?
I would say if you have been thinking about making gifts in the past, now is the time. Do not wait. It's not going to be a better environment than it is today. And there are options, right? With regards to, I mentioned earlier, I want to have a backup plan. I feel like I have enough money. I probably have enough money, but just in case, is there a way I'm going to be able to get access to stuff? So that's one thing that we should be having conversations with our advisors on. Other things would be thinking about folks that already have these trusts in place. And we call them grantor trusts, but there are different terms for it, right? Like, for instance, a lot of folks have what we call an ILIT, an irrevocable life insurance trust, very often treated as a grantor trust for income tax purposes. If this proposal were to become law, it doesn't grandfather the trust itself just because it existed prior to date of enactment. It only grandfathers contributions to the trust. So if you were to make contributions, let's say after date of enactment, they wouldn't have the same protections that they do today. So if you do have one of these trusts already in existence, you're going to want to talk to your advisor to really understand the consequences and thinking about, normally I make all of my gifts in December. A lot of us do. We shouldn't, right? It's good practice to make your annual gifts in January. But a lot of people wait until the end of the year and they make their gifts. Don't wait until December this year, particularly if you have one of these trusts set up. Make those gifts today. And then you know that you're going to beat any change in the taxation of these trusts.
Thank you. Thank you. One question that came through, it's asking about contributions or gifting and whether that can be done in the form of a note payable. Can you answer that, Melissa?
There are different things that you can do to use the 11.7. Some of the things that we've thought about, you may have already done a note to a trust, right? Or they've done it. Usually it's the other way around. The trust does a note to you. You may want to forgive it. You may have notes to your children, right? Where they borrowed money. Okay, you set up a promissory note. You may want to forgive those notes. So there are a lot of ways to utilize that 11.7 without having to look for more cash in your bank account.
Thank you, Melissa. So, I really think, this is very technical guidance, and I really hope that our viewers today will reach out to us and consider, having a conversation. A lot of this technical guidance needs to be tailored towards your needs specifically. So I want to thank you both for joining today, Melissa and Tammy. It's really been a great conversation. I want everyone to be aware that we do have a couple recent articles that have been released And you could find those on our CLA website by clicking our insights and then doing a search through our catalog for our technical write-ups and our articles and white papers. Please also register and engage with us for future live streams. We love having you be part of the conversation with us. We'll see you for our next live stream on October 17th, or October 7th, I'm sorry, jumping ahead. Melissa and Tammy, once again, thank you so much.
Thank you.
Matthew.